Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello, and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy, and today I have the pleasure of speaking with JP Dividends. JP, go ahead and tell the people a little bit about yourself.
Hey, thanks for having me on, Troy. I really appreciate it. A little bit about me. I've been investing for about 3 years now. I have a dividend YouTube channel where I talk about dividend growth investing and basically like how to grow a money tree where you put money in and that tree grows and it gives you more money back. And you basically just grow that dividend snowball over a long period of time, owning really good companies or really good ETFs. So that's just a little bit about my channel.
Yeah, I like that. It sounds like we have, I've seen a couple of your videos. It sounds like we have similar, thoughts behind dividend investing, doing it the right way, doing it the slow way.
Yep.
It's my pleasure to have you on the channel and, talk to my subscribers, and maybe some of my subscribers will come check out. It's at JP Dividends or JP Dividends on YouTube. So definitely go check them out there. So
Awesome. Yep.
all right. So first question, you answered a little bit of it. So when did you begin investing? So you said about 3 years ago, but
Yep.
what intrigued you? Like, did you start with dividends or did you go down a little rabbit hole towards something else for a little bit, or how'd that work?
Yeah. So during my time in college, I actually was job shadowing a financial advisor, and I kind of knew like the smart path based on what he told me. It was like, buy good ETFs, buy really high quality companies, don't buy like, really bad businesses. And so when I actually started out, me being a broke college kid, I was just basically trying to trade options and turn $50 into 100 as quickly as possible. So that was like March of 2020. So I'm over here trading options while the market's dipping. And then a couple months later, from March to May, the market starts to rebound really good. And I'm like, okay, I need to quit trading options and kind of gambling over here. And so then I started just kind of looking to like dividend paying stocks. I don't remember how I found out about dividends, probably just some other YouTube channel that I came across. But I think I started with dividends around like May of 2020. And then at first I was kind of chasing high yield. And then I slowly transitioned, like within the first few months, I transitioned from, okay, let's not go for high yield. Let's go for high growth and not really worry about the yield.
So do you, you sound like you started with like exactly how most people start with, before they start dividends, it's kind of like the get rich quick kind of thing.
Yep.
And then they transition into get rich a little bit slower, but also still too quick with high yields.
Yep.
And then they end up, if they end up transitioning, it goes into like regular, more stable dividend companies after that. So that's very interesting. You're like I don't know how many guests I've had, 24 or something like that.
Yeah.
And I think everybody said the same version of a story. So one thing I found interesting about your story is that like, it seems like you're able to pivot very quick. Like you don't waste years on something, you waste like a couple months. So like, do you see that as a strength in your like investing journey so far? And like, has that also become like a weakness? Like, do you sometimes pivot your strategy too quick before you can even realize if it worked or not?
Yeah, no, I mean, that's a great question. I would say for the most part, my strategy, I would say that first 6 months, like from March until like July of 2020, I was just trying to figure out what is a good strategy. And so I feel like since then, I've kept the strategy pretty consistent in the sense that, research businesses that are growing, revenue, profit, free cash flow. Let's look at the valuation of them. Okay, do we think they're going to continue to grow over a long period of time? Yes, we do. Okay, let's just buy them and hold them. And so that's tend to be like kind of my strategy. The one thing I will say is it has changed a little bit, but for the most part, I try to keep it pretty consistent. So I would say that it definitely could be a weakness if I change a lot, but I feel like I haven't, anytime I've changed, it's always been for the better.
Yeah.
Like going from like high yield to like, lower yield, higher growth stocks where I'm actually getting way more capital appreciation. I'm not just chasing the yield. Like that's made me way more money than had I stuck with high yield. And one other thing I've kind of done recently, I've talked a little bit about this on my channel, is focusing more on ETFs, because out of the past few years I've been investing, I've had some years where I'm outperforming the market. But for example, like this year, I'm like slightly underperforming the
Mhm.
market. And so for me, like I'm going to try to focus a little bit more on putting money into ETFs just to kind of get rid of, kind of put my ego to the side in a way. So anytime I've tried to make a change, I feel like it's been for the better and it's helped me make more money in the long term. So
Yeah, and since you have a channel, you could probably relate to this. The hard part with doing the ETFs. So I have my Roth IRA, which is only ETFs and Tesla.
yeah,
So your VOO, SCHD, your
yep,
VYMs, like stuff like that. Uh, I think that's the real estate one. I don't remember. I don't look at it. That's the point of it. I don't look at
yeah,
that portfolio. I did all the research one time and then I stopped looking at it and I just add money to it.
yeah,
But that's boring for like a YouTube channel. So I feel like
exactly,
we
yeah,
do struggle with that. It's like, okay, is anybody going to watch the YouTube video if I'm just sitting here talking about like, oh, every 3 months I'm going to get paid from SCHD and VOO? Like, no,
yeah.
that's
I
not
have two
interesting.
holdings.
Yeah,
Yeah,
yeah. So
no,
you have to
exactly.
like balance that with like, okay, I want to try to outperform the market with individual holdings. I don't want too many individual holdings because it's too much work, but I also don't
Yeah,
want to try to like do something that's very hard to do, but outperforming the market because, like I said, that's very hard to do. So
yeah,
like, I don't want to constantly underperform the market by 1% every year because that adds up a lot.
yeah,
So
exactly.
it's a balance for sure. And I feel exactly what you said before because I do like informational paralysis. I get a lot because like I don't know anything
Hmm.
about something that I want to know, and I just learn,
Yeah,
learn, 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 learn. So like so much so quick that like okay, I did this strategy. Okay, that works. Now I'm gonna do this. Like when I at one point I had 39 holdings, 3 ETFs, and 36 individual stocks, and like
yeah,
I only at that time my portfolio was worth like 8 grand, and I was like I am spread so thin. I think I had like an average of like 0.68 shares per company. And I was like, I'm not
yeah.
going to get anywhere with this ever. Like, it's going to take me forever.
Yeah, because every company is like 500 or $200
Yeah.
holding
Yeah.
or
Yeah.
yeah,
It's just so like you're spread, like you only have 10 grand spread within 39 positions. I'm like, you're not going to have any significant skin in the game no matter what happens. So
yeah.
now I have 11 holdings. I have 6 ETFs in Tesla in the Roth IRA. And
Mhm.
I just kind of do that. So it is interesting the way that works. And then there's one thing that bothers me is there's always like a quote, but then there's always a counter quote that nobody ever thinks about.
Yeah.
It's always like the glass half full. So like an example of this is like early bird gets the worm is like a common quote everybody has always heard.
Yep.
But then there's always the counter quote of good things come to those who wait.
Yeah.
And I'm like, literally, those are talking about the same thing. But if if something bad happens when you wait, they're like, well, what they say, early bird gets
Early
the
bird
worm. And
gets
I'm like, well,
yeah.
that's annoying. Like, you can't do that. So like, it's one of those things where like with investing, like what Warren Buffett and tons of other famous investors has always said, like you want to identify things and then just leave them alone. Like the often the
Yeah.
best performing portfolio is one that you don't mess up.
Yeah.
So like that's one thing that I feel like you or I can like identify with and we might end up struggling with is because we do keep learning and then you are really good at pivoting quickly. So if you
Yeah.
learn something tomorrow that blows your mind and you're like, well, this is completely different than what I've thought, then you're
Yeah.
like, you're going to change your thing. And like, Warren Buffett's like, don't just stop touching it and it'll do its thing.
Yeah. No, that's definitely the hardest part is like being able to kind of like just sit on your hands and like not do anything. That's like one thing I've been rereading this book. It's called like the Little Common Book of it's like this little red book. It's written by John Bogle, the CEO of Vanguard. And it's basically talking about how like some of the best investors are actually like everyday people like you and me. The best investors out of us are typically dead people because they
Yeah.
don't touch their stocks.
Yeah.
Obviously, they're not selling. And so that anytime I've read that, I'm like, okay, just got to remind myself, like, do not be emotional. Like, try to just, buy and hold them as long as you can. Now, obviously, if the business model changes or, revenue starts tanking over a couple, quarters or years, then, reevaluate. But I completely agree.
Mhm. Okay. So, segue into the next question. So, what
Mhm.
would you pinpoint as your biggest dividend mistake that you've made? But I always say, more importantly than the mistake you made, is what lesson did you learn from that mistake?
Yeah, I would say the biggest dividend mistake I made was probably owning Intel for a while. I haven't owned Intel for like over a year now, but when I first bought Intel, it was kind of like a slower growing business. It had a really low PE ratio. And kind of looking at that sector, it's like, okay, you got AMD, you got NVIDIA, and then you got Intel and AMD and NVIDIA. They have all the growth, but they seem super overvalued. And I'm like, hey, here we got this, this beautiful, like, value stock play. This is going to be awesome. And I think my average cost on them at the time was like around 40 to $50. And they were doing decent for a little while there. And then when I initially bought into them, the revenue was going up, but not that much, like 4% a year, 5% a year. And then all of a sudden I started noticing, okay, their revenue is now flat. Like this most recent earnings report, it went from being up 5% to now it's not up at all. And then it kind of switched. So then now it's, later on the next quarter comes around, now the revenue is negative. So I think the main mistake I made there was buying a company that was, it's kind of like the Warren Buffett saying, like, we don't like to buy like cigarette butts. They talk about that, like him and
Mhm.
Charlie Munger, like a company that's super beaten down that you could buy and get a couple more puffs out of it. They try to avoid that, instead hold really good businesses over a long period of time. And so I think the main mistake I made with Intel on that was just thinking that it was going to bounce back super quickly, which I think long term they probably will. But at the time when I bought them, I did lose a little bit of money, not much, but it just kind of seemed like I was trying to, smoke a cigarette butt there and, get a quick return out of it when I really shouldn't have. So,
Yeah. Well, I mean, like I said, the most important thing for these is always like identifying that you made a mistake, and whether
mhm.
you want to call it a mistake or a lesson learned or whatever it is, and
Yeah,
realizing the cost of that lesson. And it's always better to make those mistakes when the lessons cost less, which, when your
yeah,
portfolio is smaller, you
exactly.
could lose 10% of your portfolio, but it's only $1,000. You lost what, $100. So
Yeah,
like that's not as
exactly.
big. But if you have $1 million portfolio and you make a 10% mistake, you're talking, that's
Huge.
100 grand. You're gonna be hurting a little bit.
Yeah,
Um,
exactly.
so yeah, I like that. That's one of my favorite questions, just because like even some people don't even think about that until I ask them that question, so they actually get to reflect and like, oh, okay, like this was the mistake I made, and like what do I take away from that? Like maybe you took away, like, another thing you could take away from that is like PE ratio doesn't, like, that's such a finicky stat
Yeah,
or metric or whatever
agreed.
you want to call it. Like I don't look at that stuff at all, because like there's some companies that I have, like Costco is an example, where
Super
Costco is
high.
always overpriced according to the
Agreed.
PE ratio, but they always do well.
Yeah,
And
Visa
like,
and Microsoft are the exact same
yeah,
way.
I own both of those, and it's just like, okay, like if you're waiting for a perfect opportunity, like there's opportunity cost to waiting. Like, yeah, you might get
Yep.
it for $3 cheaper per share than I did, but I also got capital appreciation. I got dividends in the meantime. I built
Yep.
extra shares because I was buying for smaller, frequent, or more frequent, smaller amounts. Like I do, I'd
Mhm.
buy every day. When I remember, I didn't add my money until Friday, so I didn't buy last week. Shame on me, but
Yeah.
I will buy next week.
Yeah, gotta double down next week,
Yeah,
huh?
yeah. So we got to make up for lost time. So, okay.
Yep.
So I mean, you kind of answered this already. You can expand on it if you want to.
Mhm.
How has your investing style changed from when you began investing to now?
Yep. So when I began investing, I would say initially it was like, who cares about capital appreciation? I'm
Yeah,
getting an 8% dividend from AT&T. Like,
yeah,
screw you guys. This is
yeah,
the best. It definitely changed from being like high yield to like, oh no, I want to make my money go the furthest. And so I feel like going from a high yield stock that doesn't really grow their dividend that much, and you don't really get capital appreciation. That was the old method. Now it's more like I get capital appreciation. It has a lower yield, but that dividend growth rate is way better. And long term, the company, like the business itself, even if you don't look at the stock price, the business itself is a lot better. The revenue's better, it's going up, the profit's going up, the free cash flow is going up. So I feel like I've changed more in the sense that I'm really trying to find like quality businesses, where at first I was like, oh, like, an 8% yield or a 7%, I'm just going to like buy that without actually like looking into like, what does the company do? Is the company growing? Is it a good valuation? Am I buying it at a crazy price right now or no? So,
yeah. Well, and too often people will try to, because it's dividend investing. Dividend investing,
yeah.
the draw of dividend investing is making cash while holding your shares.
Yep.
Um, Too often people just want that money now, even though they don't need the money now. And like, I don't,
Yeah.
if somebody was to say, hey, do you want $1 today or no dollars tomorrow? Like, of course, give me the dollar today. But
Yeah.
like, that's not the question that dividend investing is asking. The question the dividend investing is asking, do you want a high yield stock that's going to pay you $80 today when you don't need $80? Or would you
Yeah.
much rather have a 2% or even a 0.5% yield in like Visa? And instead of like,
Yeah.
you'll only get, whatever, let's just say $1 today, but in 20 years when you need it, you'll be making $1,000. Like
Exactly.
that's what's important. So like understanding timeline and stuff is very important. And nobody cares about what 20 years, like I always, like, one thing I'm trying to do for like 2024 is like
Hmm.
ask myself, like, how can I make things easier for future Troy?
Yep.
And this is not just like dividend investing. This is just like in life. Like for me,
Everything.
it's like,
Yep.
okay, I have a bowl that I'm putting next to the sink or in the sink. Like, would it be better for future Troy for me just to wash this bowl, it take 10 seconds to wash it right before I go to bed? Or would
Yep.
it be better to wash it in the morning when I'm tired and don't want to do anything? Or maybe I'm running behind or whatever.
Yeah.
So like it's one of those things. Like if you can ask yourself that, like what would be better for future you, and would it be better for future you to buy TSLY today, or would it be better to buy Tesla and have Tesla? Maybe Tesla pays a dividend 20 years from now. Who knows? Maybe they don't
Yeah.
pay a dividend, but your 100 shares at $100 each is now 600 shares at $7,000 each. Like who knows?
Yeah.
So yeah, all just stuff to think about. So I don't know how that relates to what we were just talking about.
No, I completely agree though. Yeah. I feel like I mean, that at the end of the day, I think that's the kind of like the main takeaway, whether you're a dividend investor or not, is like, how can you make your money go the furthest? Like if I invest $100 today, like, yeah, I could get an 8% dividend, but if that initial $100 goes down to $70 in 2 years from now, like if my initial investment's dropping, then at that point you might as well just put it in a savings account, So
yeah, I hear so many people on the groups I'm plugged into where it's just like, they like justify the decision to buy high yielders because they're taking the dividends received from the high yielders and buying good stocks with them. I'm like, yeah, but you put $1,000 into TSLY to have that go down to $495. They're going to pay you $600 in dividends when you could have just and you're going to use that to buy Visa. I'm like, why wouldn't you just put the $1,000 into Visa? That'll be now worth $1,400. And in the meantime, Visa's also paid you $200 in dividends that you can then use to buy more Visa. I'm like, why? Like I don't know who you're like, what kind of mental gymnastics you're doing to make that make sense, but I don't get it.
Yeah, no, I completely agree. The way I kind of view it is like I just follow the numbers. So like for me, it's not even like an emotional thing. It's just like where's the money going to go the furthest, and I'm going to try to follow that. I feel like some people they don't like sit down and actually like look at the numbers.
Yeah, well, the numbers that they care about is what do they see coming in? Like when they do a video, not even that they're doing videos, but if they were to do a video, they get the report that they made $1,900 this month in dividends, while me or you only made $200 this month. I'm like, yeah, but
you've lost 10K on
yeah, you lost 10K. Yeah, your initial investment's now worth less, and your $1,900 is only going to stay $1,900 because you're adding $2,000 of your new money to that every month.
Yeah,
because like in the case of like TSLY and some of these other, like I always pick on the yield max stuff, but like some of those are dropping their dividends like month over month. So like in order to get the same amount, not only are they losing your capital, but you have to add new money to get the same amount of money that you just got.
Yeah, exactly. Like, so your income's going down over time.
Yeah, yeah. If you stopped adding, and like if pretend you do need to live off of that money from TSLY, that $1,900 that we're making, like you're not adding that back to the portfolio. Next month when they lower their dividend by 20 cents per share, like they've been doing, like you're now making significantly less because you're not rebuying and you're not adding new money to your portfolio.
Yeah. That to me is just so dangerous to do. Like, especially if you're going to retire off that.
Exactly. Yeah. Especially if like dividends is your source of income, like you're kind of screwed.
Yeah. No, I completely agree. I've seen like a few, for some reason, the Dividend Facebook pages, I see a lot of people on there that'll like post like, oh, I have like a $200,000 portfolio, but then it's in like a bunch of this like high yielding stuff. And I'm like, well, if this person's going to like try to retire off this, like their income's going to go down. They're going to go from making 20K a year, 30K a year to making the next year it'll be 18K and then 15K. And then because they decrease their dividend, there's not much you can do at that point.
Yeah.
So,
yeah. Well, I mean, that's why one of my metrics is like at least a 5-year dividend growth rate, or not dividend growth rate, a streak of growing your dividend.
Yeah.
And that's just showing me that like, because to me, I don't like the company that's like, oh, here's a dividend. Oh, we're suspending our dividend. Oh, here's a dividend. Oh, we're going to raise it again, but now we have to cut it. I'm like, that's not like, if I want to create a reliable source of long-term income, like I can't have you chopping and screwing your dividend all the time. Like I can't, that can't be a thing that's in my portfolio.
Completely agree. I think Disney, AT&T, or Intel are kind of all fall into that bucket where it's like, oh, we're chopping our dividend. Oh, we're bringing it back.
Yeah.
Oh, we're kind of growing it, but if something goes bad, we're going to cut it again. You know?
Like your freaking your stock chart and your dividend growth portfolio, not your portfolio history, but your dividend growth chart shouldn't look like an EKG. Like it shouldn't be like that's
a heart
not good.
monitor. Yeah.
You don't want that. So
agreed.
Okay, so you are, I don't know if you mentioned this in your intro, but you're 25.
Yep.
So you started when you were 22.
Yep.
If my math is mathing. So let's just say the next 6 months and then the next forever. So in the next 6 months, what are your short-term goals that you hope to accomplish with dividend investing? And then what are some of your long-term? Like what's the end goal?
Yep. So short-term goal, one of my main ones is getting my annual income to $1,200. Right now I'm at 1,193. So I'm like $7 away from getting that. The reason that's a goal is because then on average you're getting $100 a month. So
And
that would just be awesome.
that's that's the projected, right? Like that's not what you made.
Yeah,
Okay.
correct. Yeah, that's my projected for the next year. Yeah.
Okay.
So if I didn't put any more money in, I'm projected to make 1,193. So yeah, that's one
If
of
you
my
don't
first
just add
goals.
$50 to your portfolio real quick and get that up there.
Well, I mean, once I get paid in sometime next week, then I will.
Okay. I was
Yeah,
like,
once I get,
that's annoyingly
it's so
close. Yeah.
close. No,
Like,
I know. Yeah. Luckily, I'll put money in next week and it'll go over. So we're all
you're gonna
good.
be real upset when it's $11.99.99.
Yeah. No, literally. But yeah, so that's one of my short-term goals on the dividend side. On my portfolio side, one of my goals is to get to 50,000. I kind of have a series right now where it's like just road to 50K. I just talk about my portfolio and my holdings. I'm sure you had a really good November, just like I did, because we have a lot of similar holdings. So that definitely helped out. But yeah, in the next 6 months, getting over 50K and then getting over $100 on average monthly dividends. Those are kind of the short-term goals. So yeah, we're on track to do that right now, which is great. And then long-term goals, I haven't thought about like super long-term, like 10 to 15 years from now, but I would like to live entirely off of the dividends. That way I don't have to withdraw any money from the portfolio. I'm 25 right now. So if I could retire off of dividends between I don't know, like 40 to 45, which I know sounds unrealistic, but I think over time, as you know, I'm not sure where you work and things like that, but as you're working and you're growing your career, hopefully your income's grown over time. So as long as I keep, investing a pretty decent percentage, I do think hopefully I can get there. So that's kind of the long-term goal, I'd say.
Yeah. I mean, to me, like that end goal is just really about like not allowing lifestyle creep, keeping your expenses low.
Yeah.
Like the wife and I combined our finances, and the first thing that we did before we like finally pulled the trigger and combined our finances is we both we wrote down all of our expenses each individually, and then we highlighted things that we could either get rid of or reduce.
Yeah, that's great.
And like for instance, we were paying $287 a month for cable because of course my basketball team plays on like a channel that nobody has, so we had to get like a super package for that. So yeah, $287, and we recently switched to just internet, and we have this thing that we bought on Amazon called a super box. It's $320, but it's just a box that connects to the internet for streaming, and it's there. You don't pay monthly. Like it's literally $320. I get all the pay-per-views. I get every sports game broadcast. Like I can, if the Thunder are playing the Sixers, and I don't like our broadcasters, which I don't, I can watch the Thunder versus Sixers. I can watch the Sixers broadcast of our game.
Oh, that's nice. So it's just a one-time payment instead of having to have that expense monthly over a long period of time. That's
so
great.
yeah, 1 month. So literally in a month and a half, it paid for itself.
Yeah,
because our cable bill, when it was cable, internet, and phone, went from $287 a month down to $79 a month for just the internet.
Yeah.
So literally $200, $210 is what we're saving every month. So in literally a month and a half, that box paid for itself. So it was pretty cool. Now the only con to the box is one, it runs off your internet, which makes sense, and two, if you want it in like your bedroom and the living room, you have to get two boxes. Like it doesn't connect to multiple TVs.
Gotcha.
So I mean that's the only con, but like I said, literally like figure out your break even point if it's 1 month, 2 months, 6 months, whatever. But then after that point, you're good. Like it's free and clear.
Yeah.
So if there's ever a pay-per-view fight that I want to watch or whatever, I don't pay for it. I just stream it and it's free.
Yeah. Same. I do the same thing.
Yeah. So it's super cool. So I don't remember how we got on. Oh yes, just
we're just talking about like living within your means and growing wealth.
Yeah, so like reducing your expenses, stuff like that. I mean, my goal, I've had the goal for the last 2 years, 3 years, is just I want to retire at 50. Now like I mentioned, I'm a big basketball fan. I'm a Thunder fan. Sam Presti's our GM. He always has like really interesting quotes, and he said something. I'm gonna mess it up, paraphrasing. He said something to the effect of like, don't set a finish line, because a lot of times finish lines like rob you of your potential for success. So that's one thing I try to keep in mind. Like 50 is my goal. I talk about it on the channel. I really want to hit that. But I also don't want to like mess up how great something could be by stopping at 50 when 52 could be great.
Yeah.
So that's something I'm battling with. I think that actually that's not the next question, but one of my questions, we can actually tie it in here, is like, how will you know when enough is enough? Like, do you have an idea, a formula behind that, or like, is it just something you're going to cross when you get there? What are you thinking?
I'm not sure. So, and part of the thing that's tough too is like you have to factor in like inflation
Mhm.
like years from now, because like obviously 100K today is going to feel like, way less 10 years from now or 15 years from now. So I think ideally if I can make between like 125 to like 150K in dividends, which again, I'm more of a low yield, high growth guy. So I'm going to have a pretty large portfolio at that point. But I think if I could retire making, yeah, between 100 and 150K in passive income a year, that would be great. But again, that's going to take a lot of consistency. I'm going to have to continually be like increasing my deposits over time. So yeah, I'd say that's kind of like the ideal number for me.
Well, so the thing that you can keep in mind, and you've probably thought of this too,
Yeah.
but you can actually do like use the 20 years that you have to grow the portfolio with these good companies, and then you
Hmm.
can transition into, instead of being in Visa that's paying out like 0.54% yield or whatever it is, you
Yeah.
can transition into something that's paying 4% yield at the time.
Yeah,
So literally,
exactly.
like you might have only put, I don't know, 150 grand into Visa, but now it's worth $600,000. You
Yeah.
sell that, you pay your capital gains tax, which is a lot less than regular taxes,
Yep.
and then you take the remaining $500,000 and you put that into something that's yielding 4%. You just gave yourself whatever that is, 8 times raise.
Yeah. Huge
Um,
increase in your income on
yeah,
that. Yep.
yeah. So and then you just keep it in whatever that 4% yield. Or if you want to go higher, if you want to YOLO into TSLY, if that still exists, then you can do that too.
Yeah.
I mean, if you put $3 billion into TSLY, even with the dividend decreases, you'll still probably make $55,000 a year in 10 years. So
Yeah. Still on your way to zero with
yeah,
that one
so
though.
yeah, you just
Yeah.
have to die before it goes to zero. That's all you need to do.
Yeah,
So
exactly.
that's
I
a
think one tough thing with that, I completely agree though. You can definitely like transition some of those lower yielders. I think the tough thing with that is if you have a really good return on one of those stocks, like, oh, I've held Visa for 10 years, it's done so well for me. Like trying to the psychology of it gets really
mhm.
tough at that point because then it's like, oh, do I want to get rid of the stock? What if it keeps running up? But I think, just being able to have a plan and have that discipline once you get to that point is going to be like huge for
Yeah.
both you and me.
It's about the emotion. Like
Yeah.
you've done really well so far, taking the emotion out of your decisions and letting the numbers tell you what to do.
Yeah.
And at that point, you're no longer, your secondary goal becomes capital appreciation. Your primary goal becomes supporting your daily living by having
Yep.
income. So like that's when you try to find stocks that, like, instead of growing their dividend at 10% a year and outperforming the market, maybe you're okay and like you don't care about the yield, like lower the better almost because they seem to perform better.
Yeah.
But maybe you switch to like, okay, like now I need a yield of at least 3.5%. Like you just change your filters around, like it's all one big Excel
Exactly.
sheet. So that's why I like being like, I'm in data analytics. So like I just, I'm really good at just like looking at the numbers and like the emotions don't matter.
Yeah,
Um,
I'm a same way. I'm a senior financial analyst, so I'm in Excel all day.
Yeah.
Yeah.
Yeah. So it's just literally like it's about, oh, okay, this formula, or not even formula, like this filter used to be 8%, now it's 6%, and you just see what comes up. Or
Yep.
so yeah, I mean that's kind of cool. So this might be the IBM part that comes in, but do you have
Hmm.
any actually no, this would not be the IBM thing. So do you have any what are your biggest selling regrets? Like a stock that you did own, you sold it and you probably shouldn't have?
Hmm.
And then what are the stock, like do you have any buying brags, like ones that you identified at a very good price and it's done amazing for you?
Honestly, okay, so starting out with selling regrets, I've been really lucky in the sense that a lot of the stocks I've sold were kind of right before they tanked.
Mm,
So for example, like when I sold Intel, I think my I didn't lose that much on it, but I remember like I think I sold them like around like 48 bucks a share. And then like the next like year, they went from like 40 something down to like high 20s. So they like
mm,
completely tanked then. I've gotten really lucky in that sense. The only stock I would say I kind of regret selling was ADP. It's like a payroll company.
mm,
I first owned them, I want to say in like August or like kind of fall time in 2020. So like August, September, October around there. And I remember like I'm pretty sure at the time they were like 140 something a share, and now they're way higher. So
mm,
they've completely ran up since I got rid of them. But I don't regret it that much because one, my portfolio is way smaller then, so I didn't really invest much, or like I didn't have that large of a portfolio then. The position wasn't that big. But also like I didn't really understand the company that well too, so like I don't regret it that much. So that's the, I guess, selling regret I would say, and then buying brag I would say probably like Microsoft and Apple. My average cost on Microsoft for the longest time, I'm not sure what it's at now, but it was like 220. And Microsoft is, I don't know, let me look this up real quick.
Isn't it? It's not. I haven't looked in like a week, but last I checked, it was like 320 or something, right?
It's actually 373 right
Okay. Well,
now.
then I've looked more recently than that, I think, unless they had a great week
Yeah.
last week. I don't know, but
Yeah, I'm not sure. I mean, it looks like they're up like 1% last week, but they did have
okay.
a really good November, I'm sure, as you saw. But
Yeah.
yeah, I was buying a lot of Microsoft from like August of 2020 until like December of 2020, and they were really flat then. But then since then, they've had a really good run up. I think I'm up almost 60% on them. So that's definitely one of my best stock picks that I've had.
Question for you.
Mm-hmm.
Are you attached? I know a lot of people that are like this, and I'm not. I am, and I'm not. So, are you overly or correctly, whatever you want to describe it as, attached to your cost basis?
No. So are you asking like, would I buy them right now?
Yeah.
No, I'm not. Like, so for example, recently, like Visa, I'm sure as we all saw, like from like July to October, the market kind of had a pullback, like a lot of stocks did. And so in the month of October, like I think Visa and Microsoft, they both had really good earnings. And I'm like, hey, I haven't bought these stocks in a while. I know I'm up a lot on these positions, but at the end of the day, these businesses, they're still growing really well. And so I put quite a bit of money or a decent amount of money into Visa. And then like, and I think I put like 500 into Microsoft, 900 into Visa or something like that. And so, no, I'm not attached to the average price at all. For me, it's more like, is the business still growing? Is it still looking really good? And then that kind of decides whether I'm going to buy it or not.
Okay. Yeah, because that's one thing that like I get a lot of like not people aren't sending me hate mail or anything, but
Yeah.
like I get slack for because like I mean, I made a video talking about like stock price doesn't matter. And I genuinely, like on my side, I believe that because I feel like I identify good companies. That's not the reason I said that. The reason I said that, spoiler alert for people that didn't watch the video, is because of fractional shares and dollar cost averaging.
Yeah.
If you buy good companies, the odds that you bought a good company, that's truly a good company, and somehow that good company is worth the same amount or less than you're paying today, 20 years from now, is slim to none.
Yeah.
So like, I don't care if I buy Microsoft at 387 today. Like everybody would be like, oh, it just ran up this much, or it's way more value, or now the PE ratio, or whatever they want to say. That's fine.
Yeah.
Do I think it'll be worth 387 or more 20 years from now? I would be willing to bet a lot of things that Microsoft will be worth more than 387 20 years from now.
Yeah.
So
No,
like, I don't
agree.
like, to me, a lot of people, when they do that, they sacrifice building shares. Like I have people, I've told this story several times on this series, people that are in some of the dividend groups I'm on that never bought Apple or Microsoft because they identified some mysterious number that was in their head that they're waiting for this stock to drop to.
Yeah.
And they missed out because it never fell to that price, or it fell within 20 cents, but they were, dead set on that price. Because it never fell to that, they never got to experience the hundreds or thousands of percent gains in Apple and Microsoft and Visa and those other companies because they wanted a certain price. And I'm like, is that really worth it? Like that 20 cents per share, are you going to care?
Yeah, I completely agree. And that kind of goes back to like the Warren Buffett quote. I feel like you and I follow this pretty well, where it's like, I'd rather buy, what is it? He's like, I'd rather buy a great company at a fair price than buy a fair company at a great price.
Yeah.
And I think that quote kind of shows that exact thing.
Yeah.
Because, and one thing I've also seen online too, that people will say is like, would you rather buy it for a higher price today or a higher price a couple years from now? Because
Exactly.
if you want to, if you want to buy it, if you truly want to own more shares of it, like it's better to just buy it now. And I mean, even if it does dip, just keep buying it as long as the business is still looking really good for you, like intrinsically. Then
yeah. And I mean, I've been doing that with Exxon Mobil and AbbVie were two of my I was killing it, like 50, 60, 70% in both of those.
Yeah.
And since they both, Exxon's been doing its own thing, like it's up and down all the time, but AbbVie has constantly gone down for a while now. So I think I'm almost break even on AbbVie. So going up from like 60% to like almost break even, some people that gets crazy. But then like when I go back and like say it was January, I was up 70%. And say this January I do another video and I look at it, I'm like, I'm even. Like some people, that's going to mess with them. But to me, the first thing I'm going to go over and look at is the number of shares I now have versus what I did have.
Exactly.
Like that's the, like I used to have 9.32 shares of AbbVie. That's great. Now I have 37 shares of AbbVie. So when it does go back up, because AbbVie's still a great company,
Yeah.
I'm going to now be way more skin in the game to ride that boat all the way up versus like, oh, I'm scared. AbbVie keeps dropping. I'm going to wait for a certain price. Like, okay, cool. You got your certain, maybe you did or didn't get your certain price, but you only have 9 shares to show for it. Like obviously we all start somewhere, but like, would you rather own 37 shares at a little bit higher cost basis or 9 shares at a little bit lower cost basis? Like, that's what it comes down to.
Yeah, I completely agree. I actually had a similar thing with AbbVie where like right now AbbVie's at like 149, it looks like. And year to date, AbbVie's down like 8%. But I've been buying AbbVie somewhat consistently. And I think my average cost initially when I was buying AbbVie was like 108. Now I want to say it's probably like 115 or 120ish, but I'm totally fine with that because like you said, like they're still a really good company. Plus, I'd rather own more shares because the dividends I'm going to get are going to be a lot higher. And once that stock hopefully returns and starts doing, better long term, then you're going to make even more money on that. So,
yeah. It's just something that I see. And it is again, it all goes back to like psychology and emotion, like we were talking about, where so many people are just so obsessed with like, that's one thing that you can hear when somebody does make a comment or talks about their dividend portfolio is they always talk about, and like rightfully so, they're always talking about, I have Microsoft at this cost basis. They never talk about the number of shares they have. Yeah. They're just like, I have Microsoft at $68. I'm like, cool, yeah, but you bought one share at $68 and haven't bought it since because you're waiting for it to get close to your cost basis. I'm like, you're just always going to have one share of Microsoft. That's what you're going to have. So,
exactly.
Yeah, so I don't know. It's just one thing, like I said, there's no right or wrong answer or like good psychology or bad psychology to it. It's just like different ways of thinking about it. And especially me and you and anybody else watching that's in like your accumulation phase, it's literally called the accumulation phase. Like your goal, don't care about your cost basis, identify good companies, get a plan that you can stick with, and literally just build your portfolio.
Yep. So, I completely agree.
Okay. So you talked about this a little bit with your short-term goals. So do you have any dividend milestones or achievements that you've recently achieved? And like since dividend investing is a long game, like what role do those play in helping keeping you motivated?
Yeah. So I would say recent goals on the dividends. I would say one kind of recent achievement I've had is in 2023, I had my first dividend that paid over $100. I got that in September. So that was really cool. And then October, I had another month that was over 100. So I would say those are like, some cool achievements just to kind of see those hundreds start to come in. Cause, as I said, hopefully I'm going to average $100 projected next year. So yeah, no, that's definitely one. And what was the second part of that question? Sorry.
Like just what role, like, because it's a long game, like what role does that play in like keeping you motivated? Like actually seeing those goals, achieving things like that and, following along.
Yeah, definitely. So that motivates me a lot because, and I'm sure you're similar. Anytime I see my dividends go up, like if I look at like this September compared to last September, and I'm like, damn, like that's a huge jump. And I only deposited X amount. Imagine if I had deposited way more, like hopefully next year I can see a similar jump. And so I would say it's super motivating, like psychologically when you have a dividend portfolio, because, the more money you put in, assuming you're buying good companies, you're going to see your passive income grow. Even if the stock price is going down, like for example, in 2022, when the market's tanking, my dividends were still going up the whole time. So it made it a lot easier psychologically when you can see that, passive income growing over time.
Yeah. I think in 2022, the S&P was down like 19%, something like that.
Yeah.
I think
right.
my portfolio was down like 8.74 or something like that.
Yeah.
And that is one, because of the companies that I'm picking, but two, because of the dividends that are coming in. Like literally it's just erasing. Like sometimes dividend portfolios will have less upside, not all the time, but less upside, but they also severely limit downside.
Yeah. And a lot of people don't understand, like if you have, $1,000 invested and you lose 50% of it, to get back to break even, you now need 100% return. Like you don't need a lot of people think, oh, it went down 50%. Now I need to go up 50%. No, it's a lot harder to get back to the break even if you have a huge loss.
Yeah. So. I mean, like look at just from the end of 2021 to the end of this year, like the S&P's back up, 19%, give or take?
Yeah, right around 20.
Yeah. So basically you're almost even from where you were in 2021 if you were to invest the last 2 years.
Yeah.
In the S&P.
Like if you just put money in like November 21 and held it to now, you'd be almost break even.
Yeah, exactly. That's again the importance of dollar cost averaging, because like you could have been buying that whole time while things were going down. And then you get the average price of that, and you might actually be a little bit ahead, and like you have more shares because you were buying the whole time, not waiting for, imagine this year, like how many times at the end of 2022 2023, we're going to have a recession. Like, oh, like they always say, I just heard a quote recently that I thought was hilarious. They say
Mhm.
bears are never wrong. They're just early.
Yeah.
And I was like, that is hilarious. Cause that's all they like, if they had to pay for predictions, like every time you opened your mouth and said something that you think is going to happen, you had to
Yeah.
pay a certain amount of money. There would be a lot less predictions.
Yeah.
Because these guys are just like, there's going to be a recession. All these, and like, of course, there's indicators of this and that and this and that. But if you would have followed Joe Schmo from CNBC, you would have missed. Nasdaq's up 40% this year.
Yeah. Like you would have missed out on a huge gain.
Yeah, like 40% in a year is not normal.
Yeah.
So
especially
like,
if somebody has like $100,000 portfolio. I mean, 40%, that's 40 grand.
yeah,
Like that's massive.
yeah, just
you know?
literally create out of thin air, like 40 grand
Yeah.
out of nowhere. And like you missed that because you thought there was a recession. Because you
Yeah.
let some dude with fire in his thumbnail tell you that, you know, something was going to go down. So,
Yeah, no, I agree.
yeah. So there we go. That's all fun for me. So, next question is, and again, you touched on this a little bit already. So what specific criteria, like do you have, one, how many criteria do you follow when you're picking your dividend stocks? And then two, what is your specific criteria?
Yeah. So my main like core three criteria I look at, and not every company needs to check all three boxes, but I mainly check to see, okay, is the revenue growing? Is the revenue growing, and how much is it growing by? Is it super flat or is it, really fast? Is profit or the net income growing? And then is the free cash flow growing? That's kind of the first three things I look at, because that's how you can tell if a business is growing or not. Even if you don't look at the stock price, just like, let's pretend you're on Shark Tank and someone's pitching a company to you. You'll notice they ask like a lot of that stuff because, are you going up or not? So those are kind of the first three things I'll look at. And then I'll look at like PE ratio. And again, like what we talked about earlier, I'm not using one metric to decide like, oh, the PE ratio is low, I'm 100% going to buy it. But I will look at the PE ratio, like the price to sales, the net profit margin, which is basically like, hey, if they make $1 billion in income, if they make $1 billion in revenue, what percentage of that is profit? So like, for example, like Costco and Amazon, they're pretty like low net profit businesses, but they're super high volume, right? Sell tons of stuff compared to something like Visa, where it's like they have like a 50% net margin. So Visa makes way more profit on that same $1 of revenue. So I'll look at, the net profit margin. And then let me think what else. I will look a little bit at like the dividend stats just to see like what's their dividend, what's the dividend yield. I don't really care that much about that. I mainly look at the dividend growth rate and then like the payout ratio to make sure they're not paying out like a ton of their earnings and dividends. And then the last thing I look at is the valuation. And I do that by, it's something called a two-stage discounted cash flows model. I basically watched a YouTube a couple years ago that like showed me how to build it in Excel. And then I just plug a bunch of numbers in there and it basically will kind of spit out a price, what they think the intrinsic value is. So, and at the end of the day, I don't use that number to be like, yep, it's 100% undervalued or it's 100% overvalued, but it kind of just gives me an idea of where the stock's intrinsic value is around. So
do you make decisions based off of that number where you're just like, okay, this is like, if it's over, like, let's just say it's 40% overvalued, is that like too much, or do you just like write it off at that point, or is there like a gray area?
Yeah. So what I would do at that point is I have had some stocks. Like I remember when I first bought Microsoft, everyone's like, it's super overvalued as a 37 PE. And I remember thinking it was overvalued. So anytime I do think I'm buying into a really good company that is overvalued, I just put money in consistently over time. That way it's like, oh, well, if it is overvalued, let me just buy it for the next 6 months. And if it goes down, great, I'm getting a lower average cost. And if it doesn't, that's okay, because I didn't dump all my money in at one time.
Yeah.
So
yeah, I do like that, like the dipping your toes in thing. That's a good way to think about it. So have you, I mean, we were talking about this before the interview. Have you noticed any trends? Like people know my criteria with the dividend streak of 5 years or more, outperformance of the S&P 500 over the past 10 years, and then a 3, 5, and 10-year dividend growth rate above 10%. Like those are my three metrics. Have you noticed any very simple metrics that end up tying into like maybe some of the more complicated stuff that you're looking at, and like how to maybe even break it down? Like obviously it's still like one of my bosses back in the day always used to say the phrase trust but verify. So you wouldn't want to just like, oh, this has a 5-year dividend streak, so we're good. Like I don't need to look at anything else. But like you want to like, have you noticed any small simple metrics that also tie into some of the like more complicated stuff you look at?
The one, I guess, small thing I would say that I've kind of noticed that with is if a company has like a low payout ratio, so the dividend's not taking up that much of their profit, and then if they're growing the dividend at a high like CAGR, like 10% plus, I've noticed those companies tend to do really well, especially if you look at their 10-year charts, like Home Depot, Lowe's, Broadcom, let me think, Visa, MasterCard, like a lot of those companies. If you go look at them on Seeking Alpha, you'll see that okay, they don't have a super high payout ratio, but they're growing the dividend at a pretty high rate. So a lot of those companies tend to do well if I just looked at like those small metrics. But again, I'm still looking at the financials on top of that.
Yeah, like I get to see that a lot with the Power 5 series that I make.
Hmm.
And the big trends I noticed are almost every week. Obviously, one of the categories is the best 10-year return. So that one's going to have the best 10-year returns. But with the
Yeah.
best 10-year return one, that one most of the time has a yield under 2%.
Hmm.
Like sometimes between like 0.75 and like 1.2%
Yeah,
is
definitely.
most common. They generally have, obviously, all the stocks I'm looking at have a dividend streak of at least 5 years.
Yeah.
But they all have like good dividend growth rates with that. So like somewhere
Yep.
between 7% and higher. The
Yep.
payout ratios are typically under 40%.
Yep. Exactly.
So it's just stuff like that. And I'm just like, okay, like if you do, like, it's basically, to me, again, it's not a right or wrong thing as much as it
Hmm.
is like setting the fewest number of barriers to getting somebody like started. Like some people will hear all the stuff that you said and they're just like, I don't know, one, what you said,
Any of
where,
that.
yeah,
Yeah.
where to find it, why it's important. Like for example, for PE ratio, one of the reasons I hate using it is like not only especially when you get into forward. I just realized this. I had somebody bring it up to me and I was like, that's a very good point. When they
Yeah.
do forward PE ratio, that's literally analysts that follow that stock that are guessing what the earnings are going to be and comparing today's price to what they think the earnings are going to be.
Yeah. It's a total projection.
And we know that literally every time there's earnings on a stock, the thing you hear is, was it a meet, a beat, or a miss?
Yeah.
That is them saying, did they do better than the analyst thought, worse, or the same?
Yeah.
So literally people that only use forward PE, I'm like, you're basing whether you do or do not buy a stock off of somebody else making a guesstimate. We'll call it an educated
A
guess on,
magic eight ball
yeah,
shake.
on what they think this thing is going to make in the coming 12 or whatever the coming period is. And I'm just
Yeah.
like, that's crazy to me that that's even a thing. But going back to PE, I've said this before, like PE between not only each sector is vastly different, but
Yeah.
PE between
Agreed.
each industry in each sector is vastly different. And then sometimes each stock within a sector and in an industry is completely different.
Yeah.
And you're just like, okay, like you can't even go on Google and you can't say, what's a good PE? Because they're going to be like 15. I'm like, okay, 15 for like what? Industrials? Maybe. 15
Yeah.
for tech? Good luck finding a tech stock with a 15
A
PE.
15 that's not shrinking in
Yeah,
revenue.
exactly. Yeah,
Yeah.
like you can find like freaking Motorola, like good
Yeah.
luck. Like you're
You
not
go
gonna
find
find that.
IBM.
Yeah,
Yeah.
exactly. So like that's one of the things that I'm just like, I like to try to find one, simple metrics that I can understand, other people can understand, and
Yeah.
two, encompassing metrics, and three, I like to try to find the metrics that are like trend identifying. Because like again, I'm
Yep.
in data analytics, so like one thing that we do is like we try to identify trends, but we try to like draw lines to trends that people wouldn't even think about. Like you're
Yeah.
just like, oh, okay, like we were just talking about with like, hey, Broadcom, weirdly, like it's like tripling the market, like not even tripling. It's like I don't even know,
Killing the market.
30,000 to like 300,000 over the last 10 years.
Yeah.
And well, start turning 10K into 300 versus 10K into 30. That's the difference. So like,
Yeah.
what does Broadcom do? They pay like a 1% dividend. The stock price is very expensive, so a lot of people see a stock price of very expensive, like dollars per share,
Yeah.
and they're
They're
like,
like,
I
it's
can't
nine
do
hundred
that.
bucks. I can't buy it.
Yeah, yeah,
Yeah.
exactly. So they're already out there. But then when like what Tesla did this a bunch of times. What did Tesla do? Stock
splits.
splits. And everybody's like,
Yeah.
"Oh yeah, I can buy Tesla now." I'm like, "You could have just bought half a share at $300, but you want to have a whole share at 150."
Yeah.
I'm
People
like,
don't
"That's the
understand.
same
It's like,
thing." Like,
yeah, it's literally 4 quarters versus one
yeah,
dollar.
just
It's
like
the
what?
exact same
Yeah,
thing.
but yet what happened? Every time they do that, there's always a run up. Like it goes
Yeah.
up like 5%.
Yeah. For
And I'm
some
just like,
reason, the
what?
psychology of people, they
Yeah.
don't get it.
Yeah, like imagine, like I give this example all the time too. Like what is it, Burke A? That's like
Yeah.
500 and something
The one
thousand
that
per
never
share.
split. Yeah.
Yeah, they never split. That's like for the people that don't have fractional shares in 2023, I feel very bad for you because you could never own that company. Like
Yeah.
trying to save up 500 grand for a share of Berkshire. That's
Just buy a
ridiculous.
house at that point.
Yeah, yeah,
Yeah.
exactly. So
Like,
it's just, I don't know. Like, I don't know. I could go on for years on there. So
going into the PE thing you just talked about, I'm not sure if we mentioned it as it's been recording, but I know we talked about this before. One thing that surprised me is we both really like Joseph Carlson, but he looks at forward PE. And I always want to comment that, like, why are you looking at, because like you said, it's just an analyst projection. And he's typically not somebody who's, he doesn't listen to news or like analysts and things like that. He's really good at kind of following the numbers, like I feel like a lot of us are. But yeah, that surprised me whenever I watch his channel. He'll mention the forward PE, and I'm like, Joseph, what are we doing there, guy? Like, he's normal.
I wonder, like you said, with your core 3 metrics, I wonder if that's just like a thing that's on his checklist when he's trying to identify a company.
I think so, yeah.
And like, I bet you most of the time that's just like something, whether it does or doesn't hit, it doesn't have any impact. Which at that point you could argue, why do you even mention that you look at that?
Yeah.
Because like I said, like the idea is how simple can you make your metrics? Can you follow your metrics? And how many metrics can you encompass in, like, how many things can you put into one basket?
Yeah.
To look at fewer things. Because if you have to freaking jump through 75 hoops every time you want to buy a stock, that could be a good thing. I mean, again, here's the glass half full.
You get a great stock, but you're never going to get one.
Yeah. Like there's so many, but like also what's one of Warren Buffett's thing is like pretend you have like a punch card with 10 holes in it and you only get to buy 10 stocks all your whole life. Like you're going to think
way
about
more
it more
careful.
Yeah.
Yep.
So, I mean, it could be a good thing that you have so many criteria that no stock ever meets it. Because if you do find one on there, it's a winner because like it's freaking every 10 years something comes on your list.
Yeah.
But yeah, I don't know. Like I said, there's no right or wrong. It's just about understanding what did I say? Staying in your circle of competence kind of thing.
Yeah.
And like the advanced metrics and stuff like that, because of the type of person I am with like my informational paralysis and stuff, I would never buy a stock if I looked at all that stuff.
Yeah. No, I completely agree. One website I do like to use to kind of look at trends is it's called Macro Trends. It's completely free. And you can just type in a company and look at their revenue and you'll see it like since the company like IPO'd to now, like how has the revenue trended? And they'll show you like, here's the year over year growth. Here's the quarter over quarter growth. So yeah, for anyone listening, go look at Macro Trends. I think that's a great website. If you want to see kind of that stuff like visualized.
Yeah, I'll have to check that out too. I don't know that I've been on that one. I've been on so many different dividend websites. I don't even remember.
Yeah, there's so many at this point. I agree.
Yeah, and then you'll like check on one. It's like, oh yeah, it's completely free, but like the free information's useless. And then they're like, oh, here's a little pop up for a membership. I'm like, yeah,
yeah, exactly.
Okay, so okay, next question. We haven't talked about this at all, so I'm really interested in your response. So, how important is staying diversified to you? And then, what rules do you set to help make sure that you're actually diversified if that's something you care about, or not if you don't?
Diversification, I don't really put a ton of emphasis on, only because my plan kind of next year is to put more money into ETFs. So like when you're buying VU and you have 500 companies, like if that's going to be a pretty large percentage of your portfolio, then that's already diversifying for you. I would say kind of the one thing that in starting out, I didn't look at this, but as my portfolio's gotten larger, I look at it is I try not to have more than like, I would say like, I don't know, like 25% in one sector. Just because like there's certain years where certain sectors do great. And I've seen that, like, for example, last year when the market was crashing, a lot of REITs I felt like did pretty good. I'm not sure about Realty Income, but I know I had Vici Properties that was doing really good. And so like the REITs were great last year, but then this year the REITs are getting obliterated because rates have gone up and stuff. So normally I'd say with diversification, I don't put a ton of emphasis on it, but when looking at certain sectors, I try to not let any of them get over 20%. But yeah, as the portfolio, like if you're first starting out like 0 to 1,000, your first $1,000, your first 5,000, I wouldn't really stress diversification that much at first, because I'm not sure how you were, but like I put most of my money into Microsoft, like starting out, and then over time you can build out other positions to diversify. So.
Oh yeah, no, I wish I was that lucky. I've changed my portfolio strategy like 8 times to get to where I am now. I made a whole spreadsheet and I had like a thing called a T-score for my name.
Yeah.
And I would like basically just sort the spreadsheet based on different things and like order them with the T-score of like what they were in that category. And then like I'd group those categories and like give that whole thing a T-score.
Mhm.
And then like I made I didn't end up making it. I made a tab on a spreadsheet for the T score portfolio. I was like, okay, if I want the top 3 in every sector for my T score, and like that's how that spreadsheet is how I got to my 39 holdings.
Yeah.
Because I was like, okay, like I forget which sheet I ended up picking from that spreadsheet, but yeah, so that ties into so the diversification question I want to ask you is, me being the person I am, where I like to like dive into information, I often make up questions that shouldn't exist.
Yeah.
How do you handle, for example, buying VOO? I think the top holding in VOO is Apple, followed by like Microsoft and Amazon and stuff like that.
Yeah, the Magnificent Seven.
Yeah. So let's just pretend it's Apple and you have Apple, and pretend it's
Yeah.
Microsoft, you have Microsoft. How do you balance like, how do you justify, not I don't mean this to sound condescending because it already
Yeah.
sounded like that. So how do you justify having VOO be 35% of your portfolio, but
Yeah.
also having 10% in Apple and 10% in Microsoft in its own separate thing? Like, how do you like make that right in your head? Because I struggled with that first. I was like, do I want to own a company individually that I also own in an ETF with a large percentage? Like, how do I do that?
Yeah, no, I think that's a great question. I don't think it's condescending at all because it is a valid point. Like a lot of people don't realize that there is a lot of overlap between certain ETFs. So they'll be like, "Oh, I have 50% in VU and 50% in the QQQ." It's like, okay, most of your portfolio is actually in like the top 7 like
Or they'll
tech
have
stocks.
like the Vanguard and the Fidelity version of VOO.
Yeah,
Like they
exactly. It's
have
like you
both
just
of
own the
them. I'm like,
same
you
thing
literally have the
twice.
same thing. Like,
Yeah, no, exactly. The way I kind of, I guess, mentally separate it is because when I own the individual stock, I really do like that individual stock. But with the ETF, like the S&P 500, that's going to change over time.
mm-hmm.
If you look at the top 10 holdings in VU, in 2010, it's way different
Mm-hmm.
than today.
When, I
Like
think
even the,
ExxonMobil is the only one that's in there, right?
I think so. Yeah, I think Microsoft, I think was also in it at the time. But yeah, it used to be like back in like the 90s and the 2000s, it used to be completely different companies. So the way I view it is that the ETFs are going to change over time. But if I still hold those individual stocks, those are still going to, they're going to be there. Like if I have 5% Apple, it's still going to be 5% Apple. But if Apple is, let's say, 5% of VU, then maybe 10 years from now, it's only going to be 2% or 1%. So that's kind of the way I view it.
You could, devil's advocate, you could
Yeah.
argue that, do you want to individually own stocks that are falling in weighting in the S&P 500?
Um,
Because
well,
aren't historically like the top 10 performers in the S&P 500 like the ones that you would want to own?
yeah, like they're typically the largest market cap. I don't necessarily think just because it's fallen from being like in the one spot in the S&P to being, let's say instead of it being 5%, it drops to a 1% allocation. That doesn't necessarily mean Apple's doing bad. It could mean that other companies are now bigger than Apple, you
What is
know?
the difference in market cap? This is not something that you would have known, but I
Yeah.
wonder what the difference between market cap between the 5th highest ranking stock in VOO versus like one that's worth 5% of VOO versus one that's worth like 1%. What I'm getting at with that is like, how realistic is that to even expect a company like you said, maybe it's not that that company is doing bad, but like for it to
Yeah.
get passed by this many other companies and the gap that it had to make up, like, is that even something that could ever happen?
I definitely think it could because, for example, like when Tesla got put into the S&P 500, they quickly became they were jumping over tons of companies. Like I think when they were first put in, I'm not sure what rank they were, like if they were in the top 10 or top 15, but I know as they started to take off, like in that 2020, 2021 range around there, they went up a lot because the market cap went up a lot. So
Yeah.
it definitely does happen. But yeah, I think a lot of the times, I mean, the market cap on those companies is so large that a lot of people don't imagine any company being bigger than Apple and Microsoft. But people were also saying the same thing about ExxonMobil in like 2005,
Yeah.
So,
Yeah.
um, you know,
Yeah. I don't think that, like I said, again, no right or wrong. It's just one thing
yeah.
that I've thought about before. I'm like, okay, well, freaking VOO has 13% in Microsoft. Do I really need to have my own 18% in Microsoft or like whatever? So,
Yeah, I think if you really love the company, like there's no problem in owning it on the side. For example, like I have SCHD, and I think I'm pretty sure SCHD has like Home Depot and like one or two other companies that I also own. But sometimes I like having more concentration in the individual stock. So I'm okay with if there's a little bit of overlap. But if it's the same portfolio, if it's the same VU versus Fidelity, like I would never do that though.
what are your thoughts on like, because I know you would actually take this and run with it if we came up with a good idea. What are your thoughts
Yeah.
on like one of your filters, like for 2024, would be trying
Mhm.
to find stocks that may or may not be in an ETF that you hold, and then building your position. Like, obviously, it still needs to meet your other metrics, but
Yeah,
like that
definitely.
could be like a last thing. Like, okay, I already own a portion of this in VOO or SCHD or whatever other ETFs you might have. Let me
Yeah.
try to find a stock that I do like that meets my metrics that's also not in those things. That way I can increase my position in that.
Yeah, no, I mean, that's definitely a great idea. I think, with VOO, it's the 500 largest companies. So a lot of those companies you'd be looking at would probably be more like small and mid cap
Mm-hmm.
stocks, which, if they're growing and like you said, if they're still checking off a lot of the other boxes for me, I think that's a great plan. So that's definitely good food for thought. I'll have to think about that.
Yeah, because I think in my HSA I have small and mid cap because it's
Yeah.
one I don't plan on looking at ever.
Hmm.
So I like, and those things have gotten destroyed for like the last 2 years.
Yeah.
So like that could be, I mean, talk about a good time to buy. Like that now could be a good time to identify a smaller mid cap. Now the hard part's going to be like identifying a small cap in my sake of that is outperforming the S&P 500 and has a
Yeah.
dividend. Like that's going to be hard to do. So,
Yeah, definitely.
but I mean, the market cap's so small that like literally one freaking shark or whale or whatever they call the big fish that swings the market, like one of those jumps in there and they could freaking cause it to go up 80% in a day. So,
Yeah, exactly. And
um,
one thing, like as companies get bigger, it's harder to keep growing. Like if
mhm.
Microsoft's worth $3 trillion, it's way harder for them to go from 3 trillion to 6 trillion, like on market cap, compared to a company that's only worth 20 billion and they have to go to 100 billion. So
Yeah.
sometimes some of those smaller companies are a lot easier. Like for like the company side, it's a lot easier for them to scale the market cap long term.
Yeah, I mean, look at the. I mean, it goes back to the get rich quick thing, which is you can
Yeah.
do that again with this kind of investing. But like when people are talking about all this crypto Shibu Inu coins and stuff like that, the
Yeah.
draw behind that was: would you rather buy a Bitcoin that at the time was 50 grand or whatever it was?
Yeah.
Again, you're not spending 50 grand, but would you rather have 0.17436 shares of a Bitcoin, or
Yeah.
would you rather have 4 trillion shares of Shibu Inu? And like you were talking about with Warren Buffett before, like it's kind of like okay, like you're getting the cigarette butts here. Like, yeah, it
Yeah.
could go up to a tenth of a penny from a hundredth of a penny, but like it could also just go to zero, like most of them do. So,
Yeah,
um,
exactly.
okay, so we have 2 questions left. We're gonna
Yep.
breeze through these. So, this question, you're plugged into the YouTube space, so this might actually be a really good question for you. So,
Mhm.
are there any dividend related myths or misconceptions that you hear often that are just not true and that you want to debunk?
Yeah, one of the biggest ones is people act like if you're a dividend investor that like you just hate capital appreciation. Like, oh, like anytime I tell people, even friends like that, aren't on YouTube, I'll be like, oh, I really like dividend growth stocks. They just assume that you like a high yield and like you don't really care if it goes up or not, or like, oh, you're not doing what's best for your money just because you're a dividend
It's
investor.
like an
And
either or.
yeah, they act like it's an either or thing. Like, oh, you should be owning growth stocks and not dividend stocks. It's like you can own dividend growth stocks like Microsoft and Apple. They have a low dividend, but most of the return that people have seen from them is from the stock price going up the last 5 years.
Mm-hmm.
Same thing with Visa, same thing with United Health Group. Like, there's a list of companies that kind of fall under this category where they still grow and they do really well, but you are getting a small dividend that grows over time. So, I definitely think that's one of the biggest misconceptions is, oh, if you're a dividend investor, you don't care about total return. That can not be further from the truth.
Yeah. Well, and the crazy thing is like some people genuinely think like that too.
Yeah,
As far as like, oh, I only care about the dividends and not my total return. Like they
yeah,
don't even know what
exactly.
total return means. They're like, yeah, my total return is $800 this month. I'm like, no, that's how many dividends you got. Like you lost $1,000 and
Yeah,
replaced it with 800. That's what you did.
yeah,
Um,
exactly.
so
You
they,
lost 200 net
yeah,
total.
yeah,
Yeah,
exactly. But they don't like, hey, you don't know about it until you know about it. Like if you
yeah.
just,
You don't know what you don't know.
yeah,
Yep.
exactly. If you just pretend it doesn't exist, then it doesn't exist. So,
Yeah.
but yeah, I definitely like that one a lot. It's just the, and you shouldn't, the thing that's the catch about that, especially the people that are telling you to just buy growth stocks, is like
Hmm.
you're literally putting all your eggs in the basket that this stock is going to grow because
Yeah.
you're not getting anything in between. And then in order for it to grow, like it has to grow. It's going to grow for a long period of time, hopefully. But then when it grows, you still have to sell it.
Yeah.
And like you
Exactly.
have
You're
to
not getting
identify
any
when to
money
sell it.
along the way
Yeah.
either.
Are you selling all of it? Are you selling parts of it at a time? What happens if you sell, oh, I'm going to sell 10% over the next 10 months until I sell it all? Cool. What happens if it goes down 20% after month 2? Like, are you abort and plan? Like, what are you, like, what happens then?
Yeah.
Because then you just you're like, okay, I should have sold 100%. And then the next stock you sell 100%, but then it keeps going up. It has a really good month and goes up 8.5%. Then you're just like, man, and you don't know what you're doing.
Yeah.
So
Exactly.
there's no fallback plan. Like there's no while you wait with growth stocks,
Yeah. I
which
completely agree.
which is one thing that, I really, really, really think that dividend investing, has on its side is you have the while you wait, which you don't have with the growth, like I just said. So
I agree. And I also think with a lot of people don't realize this, but there's a lot of people that are like in that growth stock camp where it's like, I only buy growth stocks. Like I'm only focused on these hyper growth tech stocks. And a lot of the reason people think that way is because from 2010 until now, growth stocks have absolutely killed. But there's also decades where growth stocks get killed. Like if you bought the NASDAQ January 1st of 2000 and you sold it January 1st, 2010, you would have lost money. Like a lot of people don't know that. There's literally decades where growth stocks get killed. And if you were building up a dividend portfolio, then maybe your dividends, like on the capital appreciation side, wouldn't have done as well, but you're still making that passive income over time. So that's super valuable. There's certain bull markets that favor growth stocks, and there's certain bull markets that favor more value and dividend based stocks. And a lot of people don't realize that.
yeah, well, I mean, the growth stocks are literally what we were just talking about, like the small and mid caps.
Yeah.
Like those are, in theory, like you said, it's way easier for a company that's worth $10 million to double than it is for Apple to double. Like that's
Yeah,
that's not
exactly.
gonna, like Apple's. Newsflash, you can little banner going across the screen. Apple will not double next year. Like
Yeah.
that's not, or in the next 2 years. Like Apple's not going to double anytime soon.
Yeah.
It's just one of those things when you get so big. Like even with me with my lifting, like when I first started lifting, like I could make 100-pound increase on my squat in a year. Now if I make a 20-pound increase on my squat, I'm doing great.
Yeah, exactly. It slowly plateaus over
Yeah,
time.
like
Yeah.
it's just if you made the same gains year over year for as long as you did, like I would be infinitely strong. Like my house, I don't like where it is. I could just pick it up and move it wherever I want to. Like that's not how it works. So,
Yep.
okay. So
Exactly.
last question for you.
Yep.
Somebody today decided that they're going to watch, or not, they're going to watch. They're going to get into investing and they're going to do dividend investing. So
Yep.
they already are going to start, and they're already going to start with dividends. What are your tips for them to set them on the right path?
Tips for somebody who is starting out to set them on the right path. The first thing I would say is invest in what you know. Don't go buying companies that like you don't understand them. And I think that's some of the chip companies can get a little tricky with that because if you're not in that space, it's hard to understand them. But yeah, I would say invest in things that you know. Like so, for example, I really like Costco stock. Part of the reason I invest in Costco is because every time I go to Costco, it's a fucking zoo. Sorry if we're not allowed to cuss, but
No,
I
you're
mean,
good.
it really is. It's insane. And so I can see that, like, I can go out and see that this business is doing really well. And then, so invest in what you know is kind of the first thing I would say. The second thing I would say is try to understand the basic financials. I'm not saying you have to understand the PE ratio and PEG and all these different ratios and metrics, but try to at least know what revenue is, know what profit is, know what free cash flow is, and try to at least look into that, whether it's on Yahoo Finance or Seeking Alpha or Macro Trends. So yeah, that would be kind of the first two things. And mainly just invest in really good businesses and hold them for a long period of time. Like I said earlier, typically the best investors that are like you and me are the dead people. So the less the less that you're buying and selling and making these emotional based decisions, typically the better you'll do in a long run. And so like, even if you own the S&P 500, a lot of people don't know this, but like I'm pretty sure the S&P 500 has never had a negative 20-year return. So typically the longer you own, the more likely you are going to have a good return. And I've even seen that with some stocks where I hold them and the first 6 months they don't do anything, and then the very next year they go to the moon, So you have to be really patient and just buy really high quality businesses. And if you don't want to do any of that, that's okay. Just buy an ETF like VU or SCHD. And yeah, so that's kind of the main, I guess, few tips I would say to somebody starting out.
Yeah, I agree with those things. It's obviously getting started is the most important. You can't go back to yesterday, but if you could, starting yesterday was better than starting today. But starting today is better than never starting. So
Exactly.
and it's one of the things I'll add to that I always like to make sure people understand is understanding your goals, and not your age almost has nothing to do with it. It's your goals and your timeline. Like when you actually need your portfolio to do something for you, that's the most important thing.
Yep.
Because like you're 25. If you had a goal of investing until, like, not even investing, if you didn't plan to touch your portfolio until you were 75 versus 40, your portfolio would probably look a little bit different. Like you might be more apt to be like more in Nvidia that's giving you your 0.3% yield or whatever stupid thing they're giving you, versus like You might not have anything over 2% yield because you're just like,
Yeah,
I have
exactly.
freaking 60 years, 50 years to let this thing do its thing.
Yeah.
So it's just timeline and actually setting goals. Also, I don't know. Can you hear that?
No.
Okay. Every day at noon, I'm in Oklahoma, so they test the tornado sirens, and it's very
Oh,
loud.
gotcha. Yeah, I'm in Texas, so I occasionally have that.
Yeah, we every day. No, not every day. It's every Saturday at noon. They test
Oh,
it. It's
gotcha.
very loud. It like swings right by my window. Very annoying. But
Yeah, no worries.
yeah. So the goals, the timeline, getting started, all those things. I don't remember what my train of thought on that was, but yeah, I agree with what you said as well.
Hmm.
It's just super important to get started. And dividend. The thing I was going to say before the siren ripped me off is
Hmm.
the importance of setting goals, but actually small and obtainable goals.
Agreed. Yep.
Because you can't say like your goal wasn't start investing. I want to make $100 a month. That wasn't what you did next. Because then
Exactly.
it takes so long to get there that you just like you would have
You
lost
lose so much
motivation.
motivation,
Yeah.
you're not going to do it.
Yeah. So you
Exactly.
step back and your first thing was like the first cool thing that you hit was $1 a day, I bet.
Yeah.
And
No,
you
yeah,
hit, yeah,
exactly.
you hit your dollar like your first, like I was tracking like, okay, cool, I made actually $1 in dividends. Oh, I had my first double digit dividend, like I got
Yeah.
$10 from something. Oh, I got, if you get a
20
triple
bucks,
digit.
25.
Yeah,
Yeah,
yeah, exactly.
exactly.
Like little stuff like that. Like, oh, I made enough to cover my cell phone bill this month in dividend. Just little things. Like if I always
Yeah.
give this analogy, if you look at a ladder is just not the bottom and then the top step. Like you're not
Yeah.
going to climb a 6-foot ladder with no steps.
Yeah.
So every 12 inches or however frequently steps are on a ladder, I think it's
Yeah.
every 12 inches, there is a step. And there's a reason for that because in order to get to the top of the ladder, you need to hit each individual step. Have you ever walked downstairs and you think you're on the bottom stair and there's always one more stair? That's
Yeah.
not fun. Like that's
Yeah,
not
exactly.
good. So like it's the same thing with your dividend investing in your portfolio and your goals is you need to set small. You don't want to set them that you're hitting a goal every day. Like that's not cool. Like you
Yeah.
set your bar a little higher,
But you
but
don't want it to be like once every couple
yeah,
years and then you
exactly.
never
Like
hit a
so
goal.
the delicate balance in between there, I think that's always a tip that I like giving to people. And tracking that stuff is so important. You don't need to be an
Yeah.
Excel whiz. I know I saw a video on your channel where you have a free Excel spreadsheet.
Yeah.
Yeah,
Yep.
so go on there's tons of them that you can find online. If you like JP's, you can check his out. There's
Yeah.
tons of other ones. They're all free, not all of them, but a lot of them are free. Just
Yeah.
tracking stuff like how many shares you have, your cost basis, how much money you made last month versus this month, like all that stuff. Super important to keeping you motivated. And you'll be well on your way. We all started with $1, literally. You all start with
100%.
something, and then you build it. Him and I are both around 50K in portfolio value, so you get there and you
Yep.
just keep building it. So.
Yep. Couldn't agree more.
But yeah, anyway, JP, thank you so much for taking time out of your Saturday to spend with me. Go ahead and once again, plug all your stuff anywhere people can find you, your YouTube channel, anything else you got.
Of course. Yeah. Thanks for having me on, Troy. I really appreciate the conversation. And yeah, if you guys want to see my channel, you can just look up JP Dividends on YouTube or on TikTok, JP Dividends. I also have an Instagram page on there, but I mainly just post the same shorts that you'd see on TikTok. So yeah, JP Dividends on YouTube or TikTok. Feel free to check it out. And yeah, I really appreciate the time. Thanks for having me.
And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see you.